Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli.
And I'm Andrew Gagan. Great to be with you on a positive day. We'll take it.
We will take it, especially when we saw unemployment hit a 2-year high. The market looking like it is going to close higher by about 0.8%, I think. Let's just bring up where the CBO 200 is, and I'll have a quick look at where the ASX 200 is. It is up 0.7%, 7,601 points on the ASX 200. But we were discussing, the three themes. This growth gala, I guess, from some of the numbers that have come through.
Well, yeah, I was trying to think of something witty and a bit of alliteration, but I came up with Thick Thursday for earnings.
Nice.
Like some really beefy results in there. Also some misses as well, as you'd expect, but lots of earnings coming to us today. In fact, this morning, Juliette, we were sort of scrambling, weren't we, trying to keep up with all the results that are coming in.
We might take that down. We've got a spelling mistake there. So we'll just talk through the jobs in terms of Swiftonomics, the impact of Taylor touching down in Melbourne. $140 million expected to be added to the economy.
How much are you contributing to that?
Just about 1 million, I think. Many hours of my time trying to get tickets on that Ticketmaster site. But, I thought it was really interesting what... I had a guest on earlier, and now you were talking to Phil O'Donoghue, but also I was talking to somebody earlier who was saying, look, the equivalent basically of the economy of Iceland per tour. Adam Dawes was telling me that.
Quite incredible, isn't it? All the economists weighing in, they can't help themselves because it is having a significant effect on the local economy. Given people like you are willing to spend on not just the ticket, but you're going to buy the merch as well? Yeah, right.
15,000% increase on Amazon for people trying to find those bracelets that I'm sure your daughters know about. You can ask them later.
No, I'm not mentioning. They haven't mentioned it to me, so hopefully that's not an issue. You're not going to buy
them any? Okay. No. Wouldn't want to be Andrew's daughter. He's not buying your bracelet. Just kidding. All right, and jobs. We touched on that. Only 500 added in January versus expectations of 30,000. Could be seasonal, though.
A bit of seasonality at play, because obviously the beginning of the year, not a lot of people they might have quit their job at the end of last year. Also, the ABS pointing out that people looking for a job or about to get a new job, which will come more likely February, March. Nonetheless, though, as you said, Juliette, for the first time in 2 years, unemployment rate back over 4%.
All right, we are going to get to our interview now with Rob Scotch, the Wesfarmers CEO, after they came through with earnings and certainly saw an uptick coming through in their share price today. Rob, thanks so much for joining us. I thought what was interesting was, particularly as we see these cost of living pressures, your Kmart business holding up quite well. Just run us through the numbers.
Sure. Well, look, across our retail businesses, we moved our sales and our profit forward, which was really pleasing. And as you said, the Kmart business was the standout performer, 26% growth in earnings. And really that was the result of the Anko private label product really resonating with Australians, both in terms of its really great value credentials, low prices, but also we've expanded the offer into new categories, youth fashion, health. We continue to get good growth across general merchandise categories, and that seems to be working well in the current cost of living crisis.
Rob, you mentioned that your retail divisions are adapting to changing customer needs. Of course, also given the cost of living pressures, must be very pleasing though for one of your segments, i.e. both Kmart and Bunnings remaining extremely resilient. What do you put that down to?
Well, look, our retail businesses and the teams, they have been really focused on trying to build a combination of resilience within their business model by focusing on everyday products that consumers and small business, large businesses need. And then on top of that, trying to look for new areas of growth. So expanding their addressable market, moving into new categories. If I look at Bunnings, while some of the big ticket renovation spending has been a bit slower of late as interest rates have been high, the Bunnings team have done a fantastic job of launching a new pet range, a new cleaning range, which is really resonating with customers. So there's I think quite a unique mix of resilience and growth within our retail portfolio.
A foray into lithium as well. When we are seeing such a glut in this market, have we seen a bottom? How is that business going?
Well, it's interesting. We feel that our lithium project is going really well. We've We are commissioning our concentrator, and in the ramp-up phase, that will be producing spodumene that will ultimately flow through to our integrated hydroxide refinery in Kwinana. We're about 65% through the construction of our refinery. So it's all going very much to plan. Obviously, we've seen a lot of volatility in the lithium price of late, particularly some low prices on the spodumene side. So that is going to impact some of the opportunistic sales we were hoping to achieve before we'd fully completed the construction of our refinery. But overall, we are a long-term investor. We're still excited about the prospects for our shareholders from completing this integrated refinery project.
Have you got some solid offtake agreements in place, Rob? I mean, obviously, given the commodity slump, are you feeling that in lithium? But more generally, the performance of your chemicals, energy and fertiliser unit has obviously been under extreme pressure.
Yeah, so it was an interesting result in our WesF business, our chemicals, energy and fertilisers business. There was a very strong operational performance for the half, but our earnings were materially down on the previous half because ammonia prices had come off a lot. And we're a manufacturer of ammonia. We use a lot of ammonia in various businesses, and that's what impacted our results. But still a good return on capital. Obviously, with lithium, there'll be further volatility there. But that is the business that these businesses are in. And what matters most is maintaining a good cost structure through the cycle. And at Wesfarmers, some businesses go up and down from time to time, but ensuring we can deliver a good return through the cycle is what ultimately should matter for our shareholders.
And Rob, also in that segment there, you're feeling the effects of lower global ammonia pricing, but also higher gas prices at the same time. I'm interested to see how you see that at the moment affecting your cost base, but also with the prospect perhaps the WA government is considering lifting that export ban to address some supply shortfalls. What do you make of that potential move?
Well, yes, it's been interesting. Over a long-term period, by virtue of the domestic gas reservation policy, the Australian public and many large-scale manufacturers such as ourselves have benefited from reliable, well-priced gas in WA, quite the opposite of what we've seen evolve on the East Coast. There have been some problems emerge recently, and we've seen a lack of supply, much higher prices approaching the very high prices that we saw on the East Coast. So the WA government launched a parliamentary review last year to evaluate what options are available to try and address these issues. Look, we're looking forward to seeing the outcomes of that review. We think that there's plenty of opportunities to deliver reliable, sensibly priced gas that will be a win-win for the win for the producers of gas because they need to deliver an appropriate return and also provide security of supply, sensibly priced gas to encourage domestic manufacturing, which is just so important if we are to take advantage of the critical minerals opportunity that is a very unique opportunity for Western Australia.
Rob, you haven't provided proper guidance, I guess, moving forward, but just how are you viewing the overall macroeconomic picture amidst the fact that we probably are seeing the peak of interest rates?
Yes, look, overall, in Australia, I think the Australian economy is in reasonably good shape, supported by relatively low levels of unemployment. The population growth that we've seen in recent years is also supporting demand. There's a number of things we have going for us. I think the risk on the horizon is that we are seeing a lot of domestic cost pressures. Certainly, businesses are facing many cost pressures, not only wage rises, which are a good thing, I should note, but we are seeing higher wages. We are seeing more restrictive and onerous industrial relations processes flow through. We're seeing higher utility costs, rent costs, and also freight and transportation locally is increasing. So I guess something that we're monitoring closely is what's happening at the domestic cost level, because as that starts to put more pressure on businesses, it will put more pressure on prices, it will put more pressure on jobs. So I think that's a watch out for the 6 to 12 months ahead.
Are there any areas where you see further cost savings perhaps? And with a view to that, today, of course, we got the latest unemployment numbers. It's jumped above 4%. How are you managing your wage costs, and is there potential perhaps you could be cutting jobs?
Well, look, I guess first of all, on the cost side, we have seen a reduction in a number of key raw materials, some imported product that we have seen reductions in prices. International shipping costs have come down a fair bit over the last year. And across our businesses, we've certainly invested a lot of those benefits back into price. We've lowered the price of thousands of items over the last 12 months as a result of that. In terms of what we're doing to face the domestic cost pressures, for quite a few years now, we've been investing in technology, new capital and systems to try and support productivity within our business. So essentially giving our team members digital tools to be more competitive, more effective, to better service customers at a lower cost. We have no plans at the moment to do any layoffs or things like that. We've been very proactive. We value our teams deeply, and we're hopeful that we can manage through these challenges by just continued incremental investment in our businesses and really working really collaboratively with our teams, because we're all in this together and we all want our businesses to be successful for the future, but we have to keep changing and evolving what we do every day.
All right, so no plans for job cuts. The dividend payment to shareholders, 91 cents. What can we expect going forward? Are we going to continue to see an increase here in payments?
Well, we always try and move our business forward. It's hard to predict the future because lots of things can happen in the external environment. But I think what's in our favour, we have really strong cash generative businesses. We have plans to keep growing our businesses, and the more profit we're making, the more franking credits we're generating, the more capacity to pay dividends. The cash generation this half was really strong, over 40% increase in cash to 2.9 billion. So our balance sheet is strong, and I feel that we're well set up for the future.
You've got some beautiful paintings behind you as well. I note that you have just given to the Canberra Scholarship Program. Can you just tell us about some of your initiatives in philanthropy as well?
Yeah, sure. Thanks for asking that question. Look, we're really passionate about our Reconciliation Action Plan, and there are various aspects of that. Pleasingly, we continue to create a lot of jobs for Indigenous team members. We now have 3.7% of our Australian workforce that are Aboriginal and Torres Strait Islanders. We also are investing more in leadership programs because we have an aspiration not just to create jobs, but to create more leadership pathways. And the Canberra Scholarship at ANU is just the most fantastic scholarship program for talented Indigenous leaders that, not only can we support them through having one of the best educations in the world, but they will then emerge to be not only leaders in their community, but leaders in Australia. And we're really proud to be a part of that. So there's a lot going on across our businesses, be it our support of the arts, be it the support of key community programs through businesses like Bunnings and Kmart, and then also the very important work we're doing on the reconciliation side.
Rob Scott, you've been very generous with your time. Thanks so much for joining us from Wesfarmers.
Thank you.
All right, some great insights there from the Wesfarmers CEO. Let's have a quick look at some of the top stories that we really focused in on, because it was a very, very busy day in terms of corporate stories. We also had Telstra, of course, in focus. I think we should get to that one because that was a big one. Net profit up 11.5% to $1.04 billion, a 9-cent dividend per share. Investors didn't really like it, Andrew.
No, as you can see, well, it was off about just over 2%. Look, we saw Magellan jump in net profit there to 104 million. Origin Energy also in focus. Look, there was criticism, AGL, are they benefiting from those higher gas and electricity prices? Well, yes, they are, very much so.
Indeed, yeah. When are they going to pass that on potentially? Arena REIT posting a dip in profits, revaluation write-downs, and Goodman Group was a big one. And I spoke to James Gerrish from Shaw and Partners earlier. He had that as a pick, and look at that, it's closed up by 7.3%.
All right, well, that was our stock of the day, and we got some analysis of that stock from Grady Wolf from Bell Direct and Howard Coleman from Team Invest.
This company is one that really stood out to me last reporting season for the full year of 2023 because it increased prices at a time when a lot of companies had to decrease prices to match consumer demand. And that didn't affect their demand at all, which we've seen today in the reporting season. And their demand, they're at 99% occupancy rate for all of their data centres. So they're going from strength to strength. This company, I cannot fault. I don't actually think it's fully priced because they have seen that they've got growth on the horizon. So yeah, a really good one. Definitely a buy for Goodman Group.
In class. In fact, I shouldn't even have put the word probably in. It's the best in class.
Yeah.
In terms of property companies, if you want to own one in your portfolio, it's probably the one. What our members find difficult with owning it is twofold. Number one, the earnings per share have roughly doubled in 10 years, but the share price has gone up 5 times in 10 years, which doesn't exactly make it cheap.
Let's bring up where the CBO 200 is, because I'm looking at the ASX 200 up 0.7%, 54 points, so closing at 7,602. Certainly a rebound after yesterday's losses, and now we can get to the market leaders as well in terms of some of the winners on the market today. Altium, I was speaking about this with Adam Dawes. He was saying, an absolute shooting the lights out, and certainly shareholders agree. 29% gain. Goodman Group we touched on, Zero, Life 360, Sayona Mining also looking good, Andrew.
Well, because the backstory with Altium there, it has received that takeover offer from the Japanese semiconductor firm, which has been unanimously recommended by the board. So as a result, you've seen that premium priced in to the share price. As far as those on the wrong side of the ledger, let's bring that up. Data 3 off significantly. Pro Medicus off the back of its results, which were broadly positive. However, of course, that stock has just rocketed recently. Maybe some profit taking there. IDP Education also. And we were mentioning Whitehaven Coal, one of those under pressure given the coal price continues to struggle at the moment.
All right, in the small end of town, Alltech BAT was up 19%. Sayona Mining gets so nice we have it twice, up 12%.
All right, and those that have gone in the wrong direction, 29 Metals, that has come off over 20%. Many other also in the energy and resources space at the moment also suffering today.
All right, well, we'll have a look at what we are going to see tonight. GDP in the UK, a big one, particularly as we're looking at certain weakness in that economy, retail sales in the US and the Empire State Manufacturing Index, and unemployment claims, of course, always a key number ahead of the actual non-farm payrolls report.
Yeah, and also the Philly Fed Manufacturing Index. That'll be another good indicator of where the US economy is travelling at the moment, certainly in that region. Import prices. And we get some further speak from the BOE, I should say, and also some industrial production and utilisation rates out of the US at the same time.
Another busy day on reporting calendar tomorrow locally. ASX will come through with its earnings, as will Centuria Office REIT, Charter Hall, Cleanaway Waste Management, Deterra, HomeCo Daily, Ingham's, QBE Insurance, lots of them.
Another busy morning ahead. I can see that right there. Also tomorrow morning, New Zealand manufacturing PMIs as well. The China market's remaining closed for Lunar New Year. All
right, let's see if we can bring you the CBO 200 where it has closed. As I mentioned, the ASX 200 up 0.7%, 7,602.
Finally, it is up. There we go.
Yes, there you go. Everybody's been waiting to see where the CBO 200 is. 0.8%, 1,458.
All right, so a positive day on the markets. Obviously off the back of those losses we saw yesterday. So interesting also just as far as some of the economic data to consider at the moment. Jobs, has that market turned? Maybe seasonality at play, we'll wait and see.
We will wait and see. All right, that does it for today. We'll be back 10 a.m. Eastern tomorrow. We'll see you then.
See ya.